Thank you all for coming this morning. We're honored to be here. As you can tell, we're pretty oil and gas focused, so that is a big deal in Houston still. Maybe in 5 years, we'll be talking about Microsoft and Apple and Tesla, but right now it's still energy. I've known Tim for 25 years. I've just met Stephen. But anyway, I think we can have a robust discussion, and we'd be glad to take your questions when we're finished talking. After 2024 in the oil and gas space that was full of M&A, some huge deals, we thought 2025 would be another great year. Tim, do you think it will be? How has it started off, and what are the barriers maybe that the government has put on things to?
Sure. Well, I guess starting in 2025, all the investment bankers were very hopeful. Not that anyone weeps for investment bankers, that it would be an amazing year. Unfortunately, it hasn't been an amazing year, and in fact, it even looks softer. So the data, if you just want to talk about the data, which probably surprises some people, relative to 2024, in the U.S., M&A volume is down 15% dollar-wise, and that's at the end of the first quarter. Now globally, it's been up about 2%, which kind of tells you a little bit what's been happening. And we obviously need to talk about what's happened since the quarter end. The last 2 weeks have been pretty amazing, and I know we'll talk about this morning. But basically, we've seen the rest of the world start to come back, particularly Europe, and M&A has gone up significantly in Europe, actually, through the first part of this year. But M&A, as you think about it from a practitioner side, it's all about the U.S. The total U.S. M&A volume represents around year over year, around 60%, over half of the M&A in the world is right here in the U.S. And unfortunately, again, for the investment bankers, it's been down 15%. We can start to talk about some of those reasons why and such this morning, but that's the data.
Another interesting data point from stuff that we track at law firms, any deal of significance typically has an HSR filing. You got to get through antitrust approval. In a given year, there are usually about 3,300 antitrust filings made. And in the first quarter, that number was about 600. And so if you extrapolate that, it's even, on some of these major deals, it's even maybe more dire than the 15% figure. The other thing, there was some positivity in March. We started seeing more deals happening, and there was a slight uptick. But I think that door got shut pretty quick at the end of March with the tariffs being, or at the beginning of April with the tariffs coming on.
Well, Stephen, you mentioned something last night at dinner about how quickly things might turn.
Yep.
You said yesterday, as soon as the stock market ran up, 2 clients called and said, we want to re-engage. So that's pretty impressive.
That's the optimistic side of it. Yeah, I mean, look, everybody's still thinking, you guys are all directors, you're on boards, your companies are still thinking about strategic things. You don't shut it down just because there's noise in the market, but deals that make a lot of sense strategically, people were like, you bill by the hour, let's not do too much on this. And then right after the announcement, I was actually in a lunch meeting. I didn't even know it was happening, and some of my former colleagues were texting on a string about how crazy it was. And then I got those calls, and it was, we're not going full bore because I want to see how this pans out. But if this is where we're headed, then potentially we will start re-engaging on these deals.
Another issue, I guess, in the last couple of years has been the FTC scrutinizing some deals. I'm curious from the legal side what you think is going to happen now. Will that get better, worse? Is the new administration going to change that?
So as we came into the Trump presidency and everybody was expecting, pro-business, pro-energy, deregulation, all that stuff, the things that you guys were all thinking about, like this is going to be a great year. The one area that my colleagues and I all gave people caution on is, the FTC under Biden was very, scrutinized deals hard and probably did so almost as a deterrent for transactions. All of the major energy deals, I sold Crown Rock to Oxy, Exxon bought Pioneer. I think you did that deal. All those deals got second requests and had to go through a longer process than they really should have. And part of that was just a philosophy of the Biden administration under Lena Khan, who was the former head of the FTC, that consolidation is bad as a general matter, and we want to, discourage this. In some ways, you can do that by dragging things out. What we've been cautioning people is the change over to Trump. So now you have Andrew Ferguson at the FTC, and you have Gail Slater at the Department of Justice. They're, depending on the industry, you'll be in either of those camps. Andrew is more free market. That's probably good for the energy industry. I think energy deals, we're not going to have that problem. I don't think under Andrew, unless it's a basin consolidation that is way above the 30% typical threshold. I don't think there's going to be problems for energy deals getting done. But Gail Slater, she's part of a group, and frankly, JD Vance is part of this, that really still thinks that we should be scrutinizing these deals, and particularly, as you might guess, tech companies. So I think as a whole, there's not going to be this open floodgate and every deal is getting through that, like the opposite of what happened with Biden. So I think people just have to have a little bit of caution. You're going to have to look at each deal through whatever industry you're in and frankly, who's scrutinizing it.
Yeah, maybe I'll just give a couple of comments from a investment banker standpoint. And this is maybe energy is interesting because energy did have a huge amount of scrutiny. And maybe just to touch on it, because I know a lot of you all may be associated with the energy industry. And what Stephen said, I'll just talk about it, is that a lot of it gets into concentration, and it's a commodity, and how much do you control the commodity? And so if there's over 30% concentration, as Stephen said, the general rule of thumb is that means it's an oligopoly, and that's too much control for one company, and then that's when deals don't get approved. And that's 30. And so the real question is, it's 30% of what? And what is the denominator? Is that 30% of your revenues come from a particular basin, like the Permian Basin? Or do you control 30% of the revenues of oil in the U.S. or 30% of the world? And I think many of you all know, but, if you took, for example, we talked about the Pioneer Exxon merger. Well, they were, I think, around 15% of the Permian Basin, 6% of the U.S., and less than 1% of the world. So the question is, but in the Midland Basin, then they start to get, I think it was around, this is a little off my head, around 22%. So the question is, what's the denominator? And the FTC, over the last 2 years, it had a lot of questions, and they were trying to shrink that denominator a lot. So there was a lot of questions about would deals get done. I think the view has been is that the Trump administration will look at that denominator being much more global, and that there's really no U.S. company, even Exxon itself, that really can control the price of oil and natural gas. We certainly believe that as an institution. But that being said, it's interesting because, frankly, it hasn't been tested. We really haven't seen, under the Trump administration, any large energy mergers. And you do hear some of the rhetoric from JD Vance, and Stephen is talking about it's been mostly towards the tech sector, but you still don't know really how it's going to be tested and what's going to be their view on antitrust matters in the energy industry. That being said, I think the general feel is it'll be much more relaxed. And we can kind of get into what's going on in 25 versus 24. Getting back to my earlier statistics, as we turn the corner of the year in, and we're enjoying our New Year's Day and so on and so forth, there was a great expectation that M&A would be much stronger in 25 than 24 because of this issue, because they thought there would be less regulatory oversight of transactions, more comfort on mergers. And of course, and it just, I pointed out in statistics, it really hasn't happened at all. We can get into why and so on and so forth if you want.
Now, if you look at the last 15 years in oil and gas, the last 5 have been wild with over 5 public deals per year. And the 10 years before that, it was more like 2. So I guess that's the question. What drove that? And whatever drove that, and I think we all have opinions, is that still around? Can it still happen? Or are we getting caught up in regulatory things and really there aren't as many targets and the synergies aren't as obvious as they used to be?
Sure.
Yeah, go ahead.
I'm happy to. Well, so we want to talk about the energy industry just for a moment, and then, and that's why I deal in day to day and known Chip for a long time. The energy industry is a hugely fragmented industry. That's kind of what we're talking about in terms of concentrations. And if we went back, it's a little bit, these numbers may not be exactly right, but directionally they are right, which is 10 years ago, there was probably literally 50 public E&P companies that were worth, somewhere between 1 billion and 1 billion and 50 billion, if you will, and probably another 20 or 30 private companies. So that's, if you look at any industry, that's a hugely fragmented industry. And then what's happened is the shale boom has matured. There's been intense consolidation among that industry for better inventory, lower costs, et cetera. So the number of that public companies that I just pointed out probably is 1/2, and also private companies that it was 10 years ago. And so there's just far fewer companies. And I think we'll continue to see that consolidation with the maturity of the energy industry. And then it's just the day-to-day, and we can get into what's causing that, but it's really that.
Yeah, so you had the consolidation wave last year, and a lot of those deals I was talking about that got kind of held up with the FTC, they all now have been cleared out. And so coming into this year, the question was, okay, so all the consolidators now are not stuck with the regulatory burden of having a pending deal, and they may be going to the next one. And so there was a lot of expectation that the smaller independent companies might be the next target of some of these larger companies. And I agree with you. I think eventually that will happen. It's just the one thing about M&A is you need some level of certainty. You need people that feel like they can put a value on their company. We may not all agree on what it is, but it's within a give or take. When you have the VIX over 50%, how can you possibly understand what your company's worth, whether it's in the energy space or anywhere else? And I think that's why you've seen this complete pause in the M&A market for the first quarter.
And maybe I just touch on that if you'd like, because Stephen nailed it in what I was going to say. So from an M&A standpoint, we really look at 4 items that are really key for strong M&A. One is high valuations. You want to sell your company when valuations are high. That's pretty simple. Okay. The second thing is you want strong capital markets, both equity and debt, because a lot of times the acquirer needs to raise equity or debt to buy the smaller company. The third thing, which we kind of touched on, is a regulatory favorable environment, or you don't want to go into because of course you don't go to the regulators until you go ahead and have a definitive merger agreement, but before closing. Just get to that, I think, as all of you know, your directors, get to that definitive merger agreement is really, really hard. So you don't want to go into that thinking you're going to get held up by regulatory authorities. So you got to have somewhat of a favorable environment. So that's the third thing. And the fourth thing is volatility. And I don't know if you all follow it, but from an investment banker standpoint, what Stephen just mentioned is the VIX. That's the Chicago Board of Options Exchange, VIX. Is a measure of volatility. We like that measure to be in the high teens or the low 20s, certainly. And you can look at it, CNBC on their website. There's a measure of VIX, and I look at it daily. Just to give you, and we can talk a little bit what's happened in the last 2 weeks, which is pretty amazing. That VIX for a long time had been in the high teens or maybe low 20s. which last year was really, really good. The VIX, just to give you a feel when you get into what's going on in the last 2 weeks, the VIX last Friday went up 50% in one day. The VIX was over 50 to kind of give you a feel. The VIX, before what happened midday yesterday, the VIX at the beginning of this week was higher than oil prices. The VIX was higher than, that is a bad stat. I'll just tell you right now. And so then we get into the issue is I was talking about earlier, year over year as of quarter end, that volumes were down. Well, because the VIX is so high right now, of course, whenever you buy a company, you know, there's two things that go into it, is your own forecast, which hopefully you're relatively comfortable about and you have confidence. But then you're buying a company, and I mean, you all are directors, you know, you're not totally sure. You do all kinds of diligence, but you don't have the same level of confidence in terms of the future projections. What you all tell me right now, but I think right now, taking future projections from a target, it's virtually impossible. I mean, you know, please tell me where the tariffs will be in 90 days in any country. And so, you know, unfortunately, I'm telling a lot of people, and I know Stephen got a couple of calls and so on and so forth. My view is the next 90 days will be a great time to go on vacation. I mean, candidly, we are working on several M&A deals right now, but and some of them may happen over the next 90 days. And I was joking a little bit, but part of that is inertia and so on and so forth. It is going to be a lot harder until we get the VIX down and more stability. And I'm sure we will do deals. I'm certainly working on two very active ones that hopefully we get done. But for the most part, you know, all joking aside, with this high of VIX, it gets much more difficult. And that's energy industry, that's a widget manufacturer. So that's, if you haven't been looking at that, I would suggest to you all, that's a really good statistic to start looking at, because it's something that, you know, frankly, people haven't talked about very much in the last 6 to 24 months. And the reason is the VIX has been low and people kind of took it for granted. VIX is really high right now. And so it's going to be discussed a lot here over the next 90 days or until things get settled.
Yeah, as an M&A lawyer, that's one of the key metrics I look at every morning. And it was interesting yesterday, the VIX itself was so volatile yesterday. I mean, to Tim's point, it was in the high 50s. The announcement comes out and it literally dropped to, I think, in 24 points. So when you have a volatility index that is itself extremely volatile, that just tells you the environment that we're looking at. I hope Tim's not right, because I don't want to, I've moved to Skadden about 2 months ago, so I don't need to go on vacation in the next 90 days. But I do think, and we were talking about this in the prep, there are some deals that can be had, but we think that, I think Tim agrees with us too, that most of them will be, you know, stock for stock transactions where it is less about, you know, is this now the right time to sell the company, or is this the right time to pay a premium for a company and use cash? You know, there's a relative valuation, and if you can get comfortable with the relative valuations of companies, even if the stock price is low, then I think those deals can get done in this market.
Yeah, I can comment on that. So what Stephen's kind of talking about, so what kinds of deals are we working on generally right now? And what kind of things are getting done? It depends on the sector, but as I talked about, a high market, pretty simple. There's nothing wrong with selling for cash. Now, in my industry, again, in energy, oil prices have come down, so we're not seeing near as many oil deals as we did. We have announced a couple of very large oil deals, frankly, already this year. But that was before we've seen the slump in oil over the last 30 days, 60 days. We are seeing, may interest some of you, is that natural gas is having a real renewal right now. And of course, Chip's on the board of, frankly, the largest producer in the United States. And And so there's a lot of gas transactions that are in discussion because the valuations got higher. So then the second question, and this really gets into all industries, as Stephen is kind of talking about, if we're in a higher volatile time, what types of mergers can happen? And that really gets into, just as he's saying, relative valuation. It can be two private companies. Some of you are on private company boards. It could be two public companies, where public companies, of course, you know that valuation every single day by just looking at that in the stock market index. And so if you have high volatile times, you can still get deals done if the exchange ratio between those two companies stays really constant. And they might stay constant if the two companies are in similar industries, similar businesses, the revenue sources are relatively similar. Maybe everything outside them is very volatile, but on a relative basis, but it might mean that both stocks are going up or both stocks are going down, but they're going down around the same rate. And it may be a lot better for those two companies to combine. So those are the kinds of transactions we're working on right now, even in these, higher volatile times. And, I may go and, I am planning to go on vacation here in a couple of months, but all joking aside, we're actually relatively busy. But I would tell you, we would be extremely busy if the VIX went down to, I wish it was 18 and it would be a lot better, candidly.
I think the biggest driver on oil and gas mergers is getting resource. We don't buy other companies generally to get their technology. We want the reserves and we want the drill sites. And in the mergers in the last couple of years, the cost per drill site has gone up to over $4 million per well. And so you have to pay that to get the drill site. Then you have to drill a $5 to $20 million well someday down the road. But nearly every company says we have 30 years of inventory of drill sites, and they really don't. It's more like 5, maybe 7. And anyway, they have to go buy other companies to get that. And so even with the VIX being crazy, if you're a healthy company and somebody with a lot of drill sites isn't, that's a pretty good target. Maybe you're gassier than oilier. That can work your way. The other thing we all tried to do was get scale. Wall Street gave up on $1 billion E&P companies. And I remember begging a Fidelity person once to buy our stock for an hour. And when I was done, they said, well, we can only own 2 stocks in E&P now, and that's Chevron and EOG. And I was like, well, thank you for not telling me that an hour ago. But, so we all started trying to combine to get to the magic $5 or $10 billion market cap number, which is now 10 billion or above. And that was the second biggest driver. I guess third was synergies, that if you can eliminate the wasted $15 million a year that you have on C-suites of small companies, that you can really do good. And so anyway, I'm still a little optimistic that there will be some deals done because healthy companies will try to buy inventory, drill site inventory, but we'll see. Because so much of that got done last year that it's hard to see who of the big companies is short now. It's probably the middle-sized companies, and they have to make the decision, do I try to get more inventory or do I try to sell to Exxon or Chevron or Conoco? And so that's an interesting dilemma.
And Chip, maybe I'll just touch on a couple of comments because if people aren't familiar with this day-to-day, it is interesting in the energy industry, and it also tells a little bit what's going on in the market. So if we go back earlier in my career and call it 15 years ago, being here in Houston, the energy industry was around 13 to 15% of the S&P 500. Enormous impact on what was going on in the S&P 500. Sadly, well, in a way, it's bittersweet, let's put it that way, is that today, the energy industry represents around plus or minus 4%. So it's gone from 14 to 4% of the S&P 500. Now, some of that is good because the S&P 500 has risen a lot, but it's risen a lot more than the energy stocks. And I think, as many of you all know, it's because really the rise of tech primarily. And we also know that if you looked over the last 12 to 18 months, there's 7 stocks in particular, the Magnificent Seven, that have really driven the market and much of the gains for the market. The problem is that what you want to get to high valuations, rather than just energy investors, you want to get the generalist investor pool, exactly what Chip was mentioning. And the challenge of the generalist investors is that your entire industry only represents 4% of the S&P 500. And, people don't like to hear this, but these are the facts, is that, do you really matter? And then it gets into, well, how do you matter? And exactly what Chip was saying. In addition, for the drive of inventory is the drive for scale. It's also lower operating costs, but also you start to matter to generalist investors. And when you start to matter to generalist investors, you tend to trade at higher valuations and higher multiples. And what you'll see in many industries, not only the energy industry, there's a relatively high correlation between size, scale, and valuation. And the bigger companies trade, generally in higher multiples than the mid-sized to smaller companies. So in several industries, you're seeing this type of consolidation play out. Then it gets back to what I was talking about earlier, a lot of the discussion, which is regulatory. So then do you have regulatory authorities that are comfortable with basically consolidation of industries, which gets back to exactly what we've been talking, Lena Khan, the FTC, somewhat the Justice Department. Lena Khan was very, very negative on consolidation in many industries, particularly the tech, in addition to the energy. So that was this whole regulatory issue that people were very uncomfortable with, which hopefully is changing, but we don't know exactly yet.
Stephen, you mentioned another thing the other day about companies moving to Texas from Delaware. What laws caused that? Why is that important?
Well, like a lot of things that happened in the last year, Elon had a big part of that. So Elon Musk had his compensation package. There was a lawsuit brought by some Tesla shareholders saying that the package was crazy and he was basically controlling the board and paying himself. That's one version of the story. The other version of the story is he took a massive amount of risk, basically was being compensated based on how much market value he grew, and he grew $600 billion in market value of Tesla. And so he was paid $56 billion. But there was a case in front of the Delaware court, and the question was, is Elon a controlling shareholder? And if so, what standard should apply in reviewing his pay package, and was the board in compliance with that? The court came out, by the way, Elon owned about 20% so he's not a majority owner, and he has one board seat, and the rest of the board members are independent directors. The court came out that Elon was, in fact, a controlling stockholder because of his ability to actually influence the board. It was like the supernatural powers of Elon. And that therefore kicked it into a standard of review under Delaware law called entire fairness. And under the entire fairness standard, the directors were not found to be as independent as they should have been. And so the package was cut. And Elon famously tweeted out, or I guess he doesn't like to say tweet anymore, he says posted out, no one should incorporate their businesses in Delaware. And that kind of set off a situation. So he reincorporated Tesla to Texas. He reincorporated SpaceX to Texas. Meta, who owns Facebook and Instagram, they are reportedly contemplating moving to Texas. Another company called TripAdvisor, you probably have, when you're planning those vacations, you probably have looked at them. They actually went and got a shareholder vote to move to Nevada out of Delaware. And so there's been a whole lot of scrutiny about this. Delaware derives a third of its state revenue from incorporation, 1/3. And so obviously, when they hear that their cash cow is at risk, they sprung into action. The end of March, I mean, it happened so fast. The legislature adopted, and the governor signed new legislation that effectively would have completely changed the outcome of the Musk case, for starters. In order to be a controlling stockholder, you either have to own 50% of the shares, or you have to own at least 1/3, and then have all this indicia of undue influence. So Elon would have been per se not a controlling stockholder. There They made a number of other changes designed to make it easier for boards, frankly, to get some clarity on when they're going through a process, what steps they have to go through. The courts had come up with this standard, and it was everything's named after a case in Delaware. So it was the MFW standard. If you wanted to do a take private, you had to, at the beginning, start with an independent committee and a majority of the minority shareholder vote. And so they still keep that standard for true take privates, but other conflicted transactions, it's now you can do it as long as you do one of those two things, either have an independent committee review it or submit it to a majority of the minority. That's a big change in the law. And the last thing they did was change the independence test for directors. There's a presumption now under Delaware law that someone who is independent under the NYSE or NASDAQ rules is in fact independent unless there's a substantial showing of the lack of independence. So I think in many ways they probably stopped the bleeding. Now you talk about Texas, our laws are under change as well. We have recently adopted a business court designed after the Delaware courts, where sophisticated practitioners are appointed by the governor to hear cases, and they can, render rulings. They can also do something Delaware cannot, which is give advisory opinions. So if a company wants to know, hey, do you think this committee is in fact independent? They can seek an advisory opinion from the court, get that kind of hammered out, and then it's really easy to go forward with a transaction with that committee. So Texas is doing a number of things to try to encourage it. And, it is a very friendly jurisdiction. And I do think, the question is, did Delaware go so far that future companies are really going to think twice about going to Delaware? I think they did enough to kind of stave that off, but I would bet you'll see more and more companies not going the Delaware route and choosing places like Texas. Other people are considering Nevada, although I think there's a negative connotation with Nevada, but it's a bit of a race to the bottom with them. They're arguably too lenient to the point that I think some shareholders would be concerned about incorporating Nevada. But I do think you're going to see more and more future companies incorporate in states like Texas.
So what industries could do well this year? And, I look at the whole power situation as kind of like oil and gas pipelines, that we need more electricity in certain spots, and we're going to have people starting niche companies and startups and able to feed the monster of utilities that need that. What else is going to?
I think you're right. In this energy space, utilities and frankly natural gas, I think is going to be, they're going to do well. There is a question, the need for power is being driven by all the AI and the data centers and the hyperscalers and the like. And, about 6 months ago, we thought that the need for power was going to go like this, right? Like so fast, almost to the point that you couldn't get the power fast enough to build them out. You had the DeepSeek situation where that was a relatively low power company that came in, and that made people kind of question it. How are the tariffs going to impact the ability to actually build out all these data centers, getting the parts and components? It's going to be more expensive. But even if it's not this, right? Even if it's not that, it's going to be this. And so there's just a tremendous need for power in this country. And I think when there's a need, there's capital that flows into it. And I think you'll see a lot of infrastructure build out. I think you'll see a lot of deals happening.
Yeah, I'll just kind of comment on that and the kinds of things we are working on. And I would say, the real two growth areas or significant difference in capital expenditures, if you will, really is in certain parts of the tech industry, as you talked about, and also the energy industry. And that really does get exactly back into natural gas. So, maybe just a couple of data points to put this in perspective. And you're hearing a lot of stuff, but it really is, what's going on right now and all this is truly amazing. And it really gets into generative AI. How is it going to change society and how much? None of us know, really. But I will tell you, the largest tech firms, they certainly don't want to be left behind, and they want to continue to be the leaders. And the leaders is we went from a shift of basically having personal computers to the internet, and then this is going to be the next shift. So what Chip and Stephen are trying to talk about, basically, if you looked, and we'll talk a little bit about the U.S., the power demand in the U.S. for 50 years, really since the 50s, a little bit past World War II, but for 2 generations, basically grew at population growth, somewhere around plus or minus 1% to 2% per year, generally. We can have all kinds of discussion, no one really knows, but I think most people feel now for the next 10 to 15 years, it will probably grow at least at 3% a year. Some people feel even 4, maybe in the very high end would be 5% compounded annual growth rate per year. That is enormous. That is enormous change. And how do you power that? And just to put it in perspective, and maybe you know some of this, but so the largest hyperscaler right now is being built by Meta in Pennsylvania. It is the size of the data center is 7 by 10 football fields. 7 by 10 football fields of computer equipment. I mean, I can't imagine that. I mean, I really can't. I mean, it's just like one building. And then, so if you think of that, to give you a feel, around 600 are being built around the world now. Obviously, most of them aren't that size, but that gives you the scope of what's going on. So then if you have that kind of scope, then really how do you power those? And getting back to what Chip was saying, generally what people feel is you can't have uninterruptible power. So what most people are focused on right now is, for the most part, it would be small nuclear reactors, small modular reactors, but we all know about nuclear and the challenges politically, can you really get those built? And then it comes back to natural gas. And that's why there's been such a major change in natural gas. So where we're seeing a lot of activity is how do you fund these hyperscalers? And that's why there is a lot of activity right now in natural gas. And I think it's something that, tariffs aside, it's going to be, a very big part of our discussion across any of the landscape. So we're seeing a lot of things going in natural gas. We're also seeing a lot in and then here in Texas as well, in Louisiana in particular, a lot with respect to LNG exports, and that's another big part. And it really gets into, how do you fuel all these different power demands really around the world? So
Yeah, and then the other aspect of that, and this is why when you asked the question, I said natural gas is. I think natural gas has an inherent advantage as a potential supplier of the power over. Under the Biden administration, they passed the Inflation Reduction Act. It put in place all sorts of incentives to invest in renewables of all types, and you turn the page to Trump, and that's all under at least consideration and probably going to have a lot of reductions. At the same time, you have the tariff issue for renewable companies who need to manufacture, their turbines, and they come from Germany, and you've got all the parts that come from Canada a little bit, and China predominantly. And so if all that stuff becomes more expensive and you remove a lot of the subsidies that was incentivizing the renewables business, it makes renewables less likely to fill that gap, which again just goes to the advantage of natural gas, because natural gas, it's relatively cheap, it is clean, and we have a lot of it here. And so I think you're going to see a ton of innovation in how natural gas is used to power a lot of these data centers.
My phone blew up yesterday when Trump endorsed coal, and nobody could believe that, but coal, unfortunately, is the best backup power source there is, because you can just have a pile of coal next to your power plant. It's even easier than using natural gas pipelines, but in my opinion, it's dirty and will never be that clean, and we're just going to need it to get through this transition until there's enough renewable and nuclear to make this work. And I guess I'm quoting Billy Bob Thornton here in Landman. I think he said the same thing.
Maybe I'll just talk about that from a Texas angle that you all may find interesting. So then it's like, okay, we're going to build all these hyperscaler, these huge AI data centers. And if you look at them across the U.S., most of them, well, the original ones, a lot of them were built in Northern Virginia because there was a lot of utility availability there. But now what's really happened is the real problem is how do you get the power from where it's being generated to where it's being used, these data centers. And the challenge is how quickly can you get, and getting back to natural gas, is how quickly can you build either natural gas pipelines or electricity transmission lines. And it's not easy. I mean, we can go into that, but it's been really difficult. Now, getting back to a little bit what's going on in administrations, that was hugely difficult under the Biden administration. The perception is it will be much, much easier among the Trump administration. But listen, these things take, by start to finish, more than 4 years. Are we going to have a similar administration in 4 years? So now what's going on is we're starting to see a lot more of the discussion that the power plants, a lot more will be based in Pennsylvania, where the Appalachian Shale is, or frankly in West Texas. In West Texas, we do have renewables and battery storage, but we also obviously have the Permian Basin. And although those are primarily oil producers, they do produce natural gas. And they're going to produce natural gas absolutely when they produce oil. And then the other advantage that West Texas has is frankly space, and you need space. So it's going to be really interesting. You'll start to see in the dialogue, if you haven't already, a lot more discussion about where these plants are going to be built, and a lot more of them will be built in Texas, which is going to be great for the state.
Do you all have any advice for directors? You must deal with directors all the time on M&A. What should they do? What should they be asking you?
Well, no, I think it's an interesting time to be a director. As we talked about, the order of the day is uncertainty, and in uncertain times, you need to have a lot of discussions with your management team about the strategy going forward. How making sure you're up to speed on how all of this whipsaw back and forth with the new rules every other day, how that is, affecting the business. A lot of vigilance on how that is affecting the business, but there is still the strategic aspects of it, and making sure that we don't get so caught up in the day-to-day changes that we're not thinking about the long-term strategic plan of the group.
Yeah, I would say, well, first thing I would say, you should hire a good investment banker and pay them well. No, all joking aside, and I do deal with it, candidly, a lot of directors and have a lot of board meetings and all that stuff. And, I think Stephen's right. I think for the most part, the directors are, a terrific group. And, I think it's an incredibly difficult task. What I would say is exactly right. I mean, and I think you're all well aware of this, but you're making very long-term strategic discussions or decisions for the companies. And so I think, really looking at, not what's going to affect the company in the next 3 months or 6 months, but what does this mean for where the company is going to be over the next 3 to 5 years? So.
Yes. I swiped it every way I could. I think we don't have enough electricity.
Other questions?
Any questions?
When technology fails you.
I was going to say for board members, thank you. Now don't touch it, Chip. So my wife said. Like Stephen said, as board members, stick your nose into the business at board meetings. Raise the issue every time. Should we be buying? Should we be selling? Holding still? Find out what management wants to do, what they will not do. You need to find out early if your comp is set up right so that there's enough change of control incentive that they might actually sell the company. And you need to look at the other board members and see if they want to ever sell the company. A lot of board members view this as salary for life and don't really want it to go away. All that going on at once. At the same time, you need to be always working on who in the company is critical that we need for retention if we do start negotiating. Because even if you just start negotiating with somebody, buy or sell, people find out, and then do your best people hit the road. And so you need somehow to identify them, figure out which extra you're going to pay them and incentivize them to stick around. And then from my own experience, communication. As a board member, you somehow need to be, once you start negotiating, talking to the board of the other company. And this can be chairman to chairman with the CEOs there, but you shouldn't just rely on management to carry this out and keep bringing you things and listening to your bankers. And bankers, no offense, but they never come in and say, this is a bad deal. And, we can't figure out how to make this accretive. I've never seen a deal that wasn't accretive. And I never realized how much my cost of capital could be manipulated to make the answer come out. But in any case, if we lost the biggest deal I was ever involved in because my board and me thought we knew what the other company was doing because I was talking to management over there all the time. And when it got down to the very end in 2014 and the other CEO went to his board and said, I've made a deal to take over this company and I want you to prove it. And they had never heard anything about it. And they basically said, no, and no, but hell no. And we really don't even want to hear about it. And so the whole thing died right there, or I'd probably be sitting at Augusta right now in one of the cottages.
But yeah, on M&A specifically, since you brought up some of the stuff you need to be aware of, I would really focus and really pressure test your management teams on the projections. It's going to be really difficult right now to have really good projections, but if you are going to do a transaction, it is going to matter what your projections are going forward and what the counterparties are if you're going to do a stock for stock deal. And you've got to make the decision based on, do I really believe in this? And the only way to do that is really to dig in, ask the questions. Like, it shouldn't just be, and usually they will bring Tim in and he'll assist with the preparation of the projections, but it shouldn't just be a presentation to you. Ask questions like what assumption is underlying all of these inputs. And really, the more you can feel confident in your company's projections, and particularly if you're going to do a deal in the space, you can feel more confident in the projections for the other company. But that will make you more confident in your decision to either say no or to say yes to a deal.
Yeah, you need outside help. Relying on the bankers for all the forecasts and the technical work is very dangerous. Last year on our Southwestern Chesapeake deal, we brought in RBC midway through the process because they were so good technically. And then we had board members sit down with them and go through individual drill sites and try to prove that our net asset value was correct, and so was Chesapeake's. And most people would just say net asset value doesn't even matter. All we have to do is look at your relative multiples and is it accretive, and you should do this deal. But you don't want to get finished with the deal and find out you can't drill any of the wells you thought were in the package. So that's important. You need help on things like tax loss carry forwards. I've never met a banker who can do that. I never met anybody in our company that can do that. But you have to go to a big firm that has people that know how to do that. And it's super complicated. And I understood it for about a day. But that was a big enough part of the deal that it would have wrecked the entire deal if we'd done it wrong. And nobody even knew that going into it. So you have to know about the other company's debt structures, your debt structures. Normally, you need to hire somebody like an EY or a McKinsey to help you with that. can we do this deal? Can we take out their bonds? Is there a GSO in there somewhere that we can't deal with, and we're going to have to give them a lot of money to go away? I mean, there's just a lot that doesn't come across in the pitch book, and you need outside help to do that. It's my 10 cents.
But how do you deal with a transaction opportunity where you have entrenched executives and board members alike that really don't want to lose their spot? And they know when the market's going like this, there's not another seat to go to. So they really, like, their self-interest. And how do you motivate, especially directors, especially when their accumulated stock has not really performed?
Go ahead.
Sylvia, I think that kills more deals. That topic that you just brought up, that kills more deals than I think a lot of, and just about any other factor, the social impact. One thing you can do as directors, so it's really difficult to look at your colleagues and kind of put a motive on them, right? Because you all are working together and have a lot of respect for each other, but you've got to be attuned to that. But the one thing, it's a little bit easier to make sure that management is motivated, and you touched on this a little bit, periodically reviewing the overall compensation, the severance structure, how your long-term incentives are treated in a change of control, to the point that management may not be like jumping for joy to sell the company because they are going to lose their jobs, but they also do have an advantage if they do leave, that they'll get a severance package that's, within market, but also encourages them to do that. It's usually the compensation issues that stop management teams from really being candid with their boards.
Yeah, I'd say, well, a couple of things that might interest you. First of all, from an M&A practitioner side, and pitch books and so on and so forth that Chip is going to talk about. Whenever we do M&A analysis and we're working for a client, we always look at the target if it's a public company, and we look at what is the change of control and management and what is the ownership of the board, because you're exactly right. And we fathom that in there. And that is a consideration when, like, should we approach this target? There's a number of things we look at before we decide to approach a target or not. That is one of the factors. And what I would say is directors, it's always a really difficult thing that, about pay and compensation of your employees and management team. But the real answer is you do want them to be aligned with shareholders, and paying them relatively high change of control is not necessarily a bad thing, because it will put their incentives in the right way. I will also tell you that from Wall Street investors, how they look at it, they think it's a good thing as well for exactly the reasons we're talking about. And i.e., the issue is like, am I overpaying these people, or am I incentivizing them to do the right thing and be aligned with shareholders on a potential M&A deal? Generally, where shareholders are, where investors are, is you'd rather have them paid well. So that is not an area that you want to be skimpy on, in my opinion.
Now, and an outside factor, which I never thought I'd say this, is activists can be helpful this way. Kimmeridge puts out a white paper every year that talks about why companies should merge and we should get rid of all the wasteful G&A in the business. And nobody likes the guy or likes the company, but he's right almost every year. And once an activist starts pointing that out to you, your board starts paying a lot more attention to that, because they feel like something bad could happen. They could lose their jobs, or there could be lawsuits. That I don't like to support activists, but they do serve a useful purpose sometimes. I had a question regarding HSR and FTC. What will they look at in the services business instead of the commodity business? Do they see problems? Will they be roadblocks in anything that's service-based?
I mean, services are pretty fragmented, but again, they're looking for signs of oligop. Never say that word. They're looking for such consolidation that it would affect competition, and they do tend to. The one thing they do is different from maybe the oil markets is they are really more focused on the geographical areas and the basins themselves, and so it's a little bit. I think I don't know the exact rule of thumb there, but it's a little bit lower in the various areas. Like, but in terms of like a fracking company in the Permian, they would have to have a pretty big part of the industry for it to really draw some concerns. I think again, it's such a fragmented group. I think there's a lot of ability to get deals done in that
Yeah, I kind of agree the same thing. The key thing you do want to look at, similar to the commodity markets, is again, it gets into control, it gets into percentage of revenues relative to the overall industry. And then again, the real key to that isn't so much what your revenues are, the numerator. The real issue is what is the denominator. And as Stephen was saying, is it worldwide sales of widgets, or is it sales in this particular region of the country, or is it the U.S.? That is the key driver. And there's widely different views of that, frankly.
We had a question on cross-border M&A this year. Do you guys think that's going to happen? I guess it depends on which border.
Yeah.
I know one that won't happen, but
I mean, I think our general view is that's going to be challenging, just in the current market. With all the uncertainty, with the varying different regimes, I'm more focusing my time and energy looking for deals in the U.S.
Yeah, I would say, as we sit here today, virtually impossible, because we really don't. I mean, please tell me where we're going to be with Canada in 30 days or 60 days. I don't know. I'll probably be a little more optimistic than that, which is if you do get, with various countries like Canada or Mexico or whatever, or Europe, if you do start to get these tariffs really actually settled and real handshake agreements and in writing, actually that may really open the opportunity for, frankly, doing a lot more deals going forward. So again, as we sit today, I think it's virtually impossible, but we may feel very different about that in 2 or 3 or 6 months, I'd say.
Yeah, just right now.
Yeah.
The one thing I will say about Canada, and this preceded obviously the election, because I was dealing with this fall. Canada, their version of the FTC and the DOJ, they have been emboldened by their government to be a little more forthright and to not necessarily, like if you're doing a U.S.-Canadian deal, just because the FTC or DOJ clears it out on the U.S. side, they still want to look at it and scrutinize things. I actually had a deal that had gotten HSR approval. They have a waiting period in Canada. It's 30 days as well. Got zero indication from the Canadians that there was a problem. And then on day 29 or maybe even day 30, they came and asked for a whole bunch of new stuff. And it was surprising to me that they would go that route. And then we got stuck in Canadian antitrust for 2 or 3 months and couldn't get the deal closed. Eventually we got through it. But again, you're seeing, at least in Canada, you're seeing a renewed spirit on them in terms of scrutinizing their transactions.
But we'll talk about Canada maybe just for a second. And I know it's isolated, but it's been in the news, and maybe just a little bit of context what's going on there, because it's pretty fascinating. I mean, you've heard all the rhetoric, the 51st state, blah, blah. But what's going on in Canada right now is that if you roll it back to end of last year, is that basically the Republican Party of Canada was 20 points ahead in the polls. And then the rhetoric that came out in the 51st state, they went from 20 points ahead in the polls to only 7%. And so the Trudeau stepped down. They have a new premier, if you will, president of the country. He has now asked for a election. I believe it's April 28th. I think that's right. Is that the right date? So a very, very quick election. Their election cycle is similar to the UK, which is really, really tight, very unlike the US. So getting back to Stephen, I think with respect to Canada, what's really going to be interesting is one, where do we sit on tariffs? And then two, what happens in this election? And we really don't know which side it'll be. If it is basically the more conservative party in Canada, and you got the tariffs worked out, we might start to see a lot of interesting M&A with Canada, and that's particularly also in the energy industry, if you will. On the other hand, if the existing party, I think they're going to be much more restrictive. The other end of the barbell, I think they'll be much more restrictive on cross-border M&A, more regulatory overseeing, combined with if we don't work out the tariff with them, it'll be actually just the opposite. It'll be really difficult. I'm on the optimistic side with Canada. They're just too important a party. I don't know which party will win, and so on and so forth, but we're going to have to work out some type of relationship on the positive side with that country.
I have a question on board involvement and integration after the merger or during the negotiation. And again, I would be proactive as a board member getting involved in that. I think the best integration I saw was where Southwestern and Chesapeake had a board level committee with management that did the integration process. And that takes out a lot of individual feelings and makes management justify the personnel decisions they're making, and is probably the best thing for the seller to have more weight in the room when you're deciding who's going to get cut and who's not. And the other thing, I guess, that goes along with that are the synergies. That's the magic sauce that can make every deal work. And they're always too high when you look at the projections that we're going to make $400 million a year by combining these two companies. And you need to dig into those numbers and find out what's real, what's not, what's duplicated. And then after the deal, somebody has to follow up on that. And my experience is management does that for about 2 quarters, and then everybody loses interest. And Wall Street quits asking also, but those are serious numbers, and you can leave a lot of money on the table if you don't carry through on those synergies. And there are people like McKinsey that'll send a team for a lot of money that will help you find those. Mm-hmm. But anyway, that's more of the same.
That committee that you were talking about, Chesapeake, was that post-closing?
No.
It was in the lead up. So the one thing you do have to be a little bit careful about is until you get regulatory approval, you can plan for integration, but you actually can't start integrating. You can't start, making drilling decisions or hedging decisions for the other company. And so there is a little bit of dance there you have to be careful about. But I do think anything that gets board oversight always ends up being better than if it's just left to the management teams. So,
yeah, I completely agree. All that. I mean, we do most things in the U.S. much better than we do in Europe in terms of running companies. But one thing they probably do, in my opinion, better in Europe, and you are starting to see more of this in the U.S., is frankly executive chairman. And you are starting to see an executive chairman that, they're not the CEO, but they're very involved in the business and from a CEO standpoint. And I think board involvement more with the companies can be a really, really good thing because they do take a more independent view. And frankly, they don't have the same vested interest that management does sometimes, and it can be really helpful. So I'd say whether it's an executive chairman or any, head of a committee of a board, getting involved in the company, getting your hands dirty are really good things. And frankly, executive management, C-suite management should be supportive of that. And if they're not supportive of that, that probably is a red flag. Like, why don't you want to hear more about my business? So I think boards, because the problem is what really happens is what you all are really, as I was talking about earlier, and what I do spend, quite a bit of my time in front of boards is that, the challenge of management, and I mean, and Chip, you've done it for many years, is that as a CEO job or CFO job, you got to get the trains to run on time, and you're so focused on what's going on the next quarter or the quarter after that and hitting those numbers, that's sometimes really hard to think about where is this company going in 2027 or 2030. And as a board member, you're not as involved in that day to day. And so you are able to think more about strategically, where is this company going? Where is the industry going? How can we reposition this company to be a leader in this industry? All those types of super strategic questions. And I think that is welcomed by C-suite, because that's when, in my business, my observation is that's it, is that management gets, too focused on the trees and not enough on the forest, and where the board can really help is to make sure that the companies are focused on the forest and making those right strategic decisions.
This is just my experience, but my general counsel would tell me and the board every day that we were going to get sued if we didn't do this and this and this as directors and management. And you need to have 10 companies in the proxy that you talk to. You have to hold an auction, all these steps. And I haven't seen anybody have a serious suit in 10 years over something they did wrong during a merger. Is that true, false?
Well, you're going to have the lawsuit. So, but the question is it going to matter, right? Because there is a lot of flexibility. And again, with the changes in the Delaware law, making it even more flexible, there is a lot of flexibility in how you run your process. The shareholder, it's more about the shareholders, I think. The shareholders want to understand, you're asking them, we're going to sell the company for $10 a share. And the reason we came up with that number is through what? And if you can to have a background of the merger that does say, we talked to all of the potential likely candidates, that goes a long way. I'll give a real world example. I sold Denbury to Exxon last year, and Denbury was a high flyer on the CCUS side. And a lot of people, when it first got announced, some shareholders questioned the premium that was there. And when they actually pulled out the background of the merger and realized that Denbury had talked to 26 different companies, and this was, in fact, the best deal that they could get for the shareholders, all that stuff went away. So I think there's a shareholder aspect to it. In terms of being protected, look, you have a lot of flexibility. You can do single bidder strategies as long as you allow for, in the merger agreement, an ability to reconsider if somebody does come out of the woodwork. There's no single blueprint on how you sell a company. But you do want legal counsel in there, because if you're going to take certain steps, you got to make sure that, like I said, you can negotiate one-on-one with somebody, but you better make sure that merger agreement gives you the flexibility. If in fact somebody is willing to pay more, you have an ability to exit. So there's all that stuff. I think you're right. Like, the lawsuits aren't the big thing. I think it's the shareholder acceptance. I think, and reputation.
One more interesting question. Do you think DOGE is going to help or hurt? That we get rid of a lot of bureaucracy and bureaucrats, but are we getting rid of people that are going to be necessary to make the decisions and get deals done?
I thought this wasn't supposed to be political. Honestly, I'll say I don't know. I don't know. I have concerns, about the level of the cuts. Obviously, we have a bloated bureaucracy and changes needed. I'm a little concerned about giving it to a very small group of people who by and large do seem to be very intelligent, but there's no way they're going to get it all right, and people are going to get hurt from it. I think there'll be benefits, and I think there'll be some disasters.
First of all, I mean, it's extremely personal and political. I guess I'd say this, maybe look at the data, and you guys can judge for yourself. If we look back 100 years ago, the federal government was roughly 7% of the GNP of the country. Today, it goes back and forth. People say different things, but most people feel it's in the high 20s to low 30s. So if you've had over the last 100 years, you've had incredible growing GNP of the country, and yet as a percentage of those revenues, the federal government has even grown much faster than the population. The size of the federal different departments is large. It's very large companies. I work for RBC. We are the largest private employer in Canada, and we have about globally around 95,000 people. The Department of Energy, that's one of the departments, of course. We're here in Houston, 110,000 people. So it's going to be very interesting. If you look at those percentages, I mean, you should just cause into question. The other thing is probably everyone knows about is the federal budget and basically when I say the federal budget, what I'm really talking about is the deficit, if you will, is continuing to grow. So I think the general consensus is that we have to get a smaller deficit. How do you do that? We can have a long debate and discussion about that. But certainly, if you do, one way to do that is reducing the size of the federal government as a total percentage of the GNP, which is what DOGE is going about. I do think, I will say, even if you're in favor of that strategically in the long term, short term, it's probably going to create a lot of, some problems because you are going to have a lot of talented people lose their jobs, and then, efficiency is probably going to go down for some period of time. But, people know how to make things work more efficiently, and then over time, do you work through that, and then you have a federal government that's a smaller portion of the economy. And if you have that, and you have does that help in terms of the deficit long term? Those are the things I'd be asking.